Good morning, everyone. This is Sharon Barker, and I'm the Vice President and COO at the Housing and Community Development Network of New Jersey. We're very happy that you're with us this morning for this webinar, and we like to make sure we start on time because you're giving us your time. And so we will begin, and there's some people still dialing in as I give you some directions, but I just wanted to tell you that the webinar this morning is being recorded. All members will have access to it on our website, and you can dial in, you can log into our website at any time. And when you put your passcode in, it will bring you to all the webinars that we've held that are there for you to review at your leisure. And I know for me, I go back and listen to webinars many times because I wrote something down, but I didn't quite get all the detail. So that is a benefit that we have been providing our members. This morning, we have a webinar on community development financing, and we are very lucky to have with us Darlene Robinson, who is the Vice President Relationship Manager for Community Development Banking at PNC. Darlene has been a very long-time friend of the network and is also one of our mentors for our Rising Leaders program, and which is still in its inaugural year. So she's one of our first mentors that has come on board. Darlene is going to present this to you this morning. We ask that if you have questions, please type them in on the screen and we will ask the questions for you. It tends to be a little more organized that way because many people ask the same type of question, so we can combine them and ask Darlene once. So at this point, I will turn it over to Darlene and let her start this, what should be a very interesting presentation. Darlene, it's yours.
Thank you, Sharon, and good morning to the Housing and Community Development Network of New Jersey members. I thank you for your time and happy summer, first day of summer today. So excited about the summer plans. But today, what we're going to talk about in the webinar are community development projects that are primarily real estate driven. They impact the low to moderate income space. We'll look at how community development banking here at PNC looks to underwrite these types of projects. And throughout the discussion, we will discuss various loan products that we use to finance these transactions. Most importantly today, I'll be providing some new information about a loan product, and it's called the Small Acquisition Line of Credit for supporting affordable housing development, since I know that's top of mind given the network's activities. So you can go to the next slide. But before I get started with going into the nuts and bolts of that, I just wanted to give a little background on PNC for the benefit of those that may not know much about our financial institution. We're headquartered in Pittsburgh, PA. PNC Financial Services Group is one of the largest diversified financial service institutions in the United States. As of the first quarter ending March 31, 2018, we have assets of $379 billion with more than 53,000 employees in 40 states across the United States and retail network of branches in more than 19 states, including the District of Columbia. We have approximately 2,400 retail branches and deposits of $265 billion. For those who are in this space of community development, which are the network primarily, we dream of building a better community for our neighbors, our children, and for our community. And PNC understands that need, and we respond with financing solutions that meet those needs. For example, in 2017, PNC throughout its footprint provided $2.9 billion in community development financing that benefited low to moderate income communities and individuals. $2 billion of that was in community development loans. That is in this segment, community development banking. $93 million were investments to benefit underserved populations, and $331 million in equity commitments through the Low-Income Housing Tax Credit Program for affordable housing, while $194 million were invested through New Market Tax Credit Program, and $294 million to restore historic properties and return them to productive reuse through our historic tax program. The types of real estate financing activities that we'll talk about are these three bullets: owner-occupied, income-producing, and housing and neighborhood stabilization. There are three of the primary areas of community development touch points that this line of business called community development banking helps to support. You can go to the next slide. Owner-occupied properties. These are our community facilities, our daycare centers that are supporting early childhood education, Head Start preschools, our health clinics. They could be federally qualified health centers, as well as the administrative offices for these various nonprofits that support neighborhood development and community economic development. Community action agencies are primarily as well into that scope. In terms of owner-occupied properties, when we look to provide solutions for those type of transactions, typically the first start might be a line of credit to support general working capital needs for that nonprofit. We look at a minimum line of credit of about $250,000. It's a 1-year term. It's annually renewable, and it's variably priced tied to the prime rate, and it's secured by the nonprofit's business assets in the form of a UCC-1 filing. And just for edification purposes, we just went through a recent rate hike in the prime rate due to the Federal Reserve rising interest rates. On June 14, the prime rate went to 5%, and that is after it going to 4.75% in March of this year, and they're expecting one more rate increase in this 2018 cycle. In addition to your operating lines of credit, the nonprofit owner-occupied properties, we're usually looking at doing some upgrade to their facility, which you may have been in your facility for some time and you're looking to upgrade it or even expand it, so you might want to build on that footprint. So we'll provide construction/permanent financing, and the maximum loan size for that is $10 million. It usually has a construction period between 12 and 18 months. That is variably priced tied to prime, and then it will convert to a fixed rate upon completion of the project with C of O. The term period is a minimum of 5 years, and amortizations can go up to as long as 25 years. It's real estate secured, and our LTV maximums that we're looking to support that project is an LTV of 80%, and we're looking at relying on the cash flow of the nonprofit owner-operator of a debt service coverage of 1.2 times. You can go on to the next slide. Just to give you some ideas of what we need to think about when it's an owner-occupied deal, where that nonprofit is really in the business of running a daycare or in the business of a community action agency. They really know that business, which is a critical community need. When you're looking to do a real estate project, that's something that's really not in their wheelhouse. So we tend to want to know a lot more detail about the development team. What is their track record and experience for doing these type of real estate projects? Have they done expansions? Have they worked with daycare centers, nonprofits? What were the size of those projects? And a key question we always ask in the owner-operator type of scenario is, do they have an owner's rep that they're going to engage, or a project manager, or is this role being fulfilled by the architect? And sometimes that is the architect, but clearly we want to make sure that that role is fulfilled, because the nonprofit really does not have experience in doing real estate project development for the most part. The goal here is for everyone concerned to build the project on time and on budget. Sometimes having the right attorney is also critical, because a lot of issues arise typically in construction projects where it's with the general contractor and its contract. So the bank is going to want to see a guaranteed maximum price, as well as having bonding on that GC's project in the event that it doesn't get completed, in all the best case scenarios, and you have to resort to bonding. But there's legal documentation with that construction contract and the scope of that contract that's very paramount, and having an attorney, a real estate attorney that has that knowledge and experience is critical. So next slide. Income producing properties. Here we're looking at where your cash flow is not reliant on the nonprofit strength necessarily, like in a owner-occupied situation. You're really looking at that specific project-based financing, which is looking at the third-party tenants, the leases, the third-party leases coming from these tenants supporting that real estate project. So the income-producing properties, we're going to look at, number one, the sponsor or developer. Sometimes they're one and the same. If it's a nonprofit that's working as a joint venture with a developer, we'll look at that joint venture and see that developer background. We look at the financial strength, see what the balance sheet looks like. We want to know how many type of projects of this similar scope and size have they done. So it's really looking at track record. Everything is really a look back and hoping that the look forward is going to be positive in this particular instance. We also want to see how involved this developer is in other projects. So the developer property schedule is another spreadsheet item that we want to look at to see how many other projects are they doing in addition to the project we're looking to finance, and where are they in timing of those projects. Are they near completion? Have some been performing? Do we want to see whether or not there's debt that is not performing on any of the other projects, because that can be a drag on the existing project that we're contemplating. We'll look at the global cash flow, which pretty much is seeing the projects that this developer is undertaking, including the one that we're looking to finance, to see that there's adequate debt service coverage, which is that magic number of 1.2 times. So that is what we want to see on a global basis. That means some projects might be doing very well because they've got some history behind them, and that could be supporting some other projects that are just reaching that 1.2 or close to it. We're going to look at those property leases, each of those leases, the term of each of those leases. And clearly, if there is one large tenant that is, the bulk or lion's share of the rental income, that's going to be a key factor in what we look at in terms of underwriting. We want to see that the lease term of the tenant equals, if not exceeds, the loan term being requested. If you've got a primary tenant that's covering 40% or 45% of the space, and they're really a good anchor tenant in the project, and we're looking at a 5-year term and the lease is only 3 years, there's a mismatch. There's definitely some shortfall that we want to make sure that we cover that in some way. And primarily also the tenants themselves, what do they look like? If you have a tenant that is a school district contract that's basically paying the rent, that's a credit quality tenant, as opposed to a tenant that might be a startup. That would be something that clearly that tenant is not considered a credit A tenant, and you don't want to have to place much weight on that particular tenant for the repayment stream. We can go on to the next slide. Some of the community development guidelines that, why is it in my space for community development banking as opposed to just another area of the bank like the commercial lending or business banking, which just looks at general commercial transactions that need financing. We want to see the benefit, the impact to low to moderate income individuals and to low to moderate income communities. So it's very intentional of the development that is being undertaken that's going to provide some positive impact to rebuild areas that have been disinvested for some time. What is the customer buying or building? What is the property history? And whether the status of that project is something that's been worked on, or in a plan that's been talked about, and how important that might be to turn around that particular neighborhood. Whether we're going to have existing or proposed tenants. What is the market strengths and weaknesses that we need to be concerned about if we're bringing a retail tenant to a project that's typically, let's say, in a mixed-use project on a ground floor? Do we have any market feasibility studies or some other type of resources and support coming from the Small Business Development Center or from the municipality that has kind of worked with the entrepreneurs. So we're really looking at it holistically to make as much as possible the project a success. Because more than anything, we're not just bricks and mortar in community development banking. We're really looking at how we transforming the community that's going to benefit from the real estate project that we're financing, and what other touch points do we need to consider. And while I'm the lender in the group, that's where I really also work in partnership with my community consultants that are the direct liaison to the nonprofits, our partners, our municipalities that are partners, so that we can bring resources and other connections to bear that will help us have a win-win in the overall development that we're undertaking. And a lot of times that's critical in working with the municipality, because if it is a project that has high significance, is on their radar, this is an area or a neighborhood that they wanted to see something catalytic occur, they're usually going to also engage their local inspectors and their construction departments to see how they can assist in the building process from the start, so that we all are on the same page. You can go to the next slide. Thank you. Underwriting guidelines for income-producing properties. Here is where structure and ownership, which is the first bullet item listed, is a critical piece. A lot of times when I deal with nonprofits, they tend to want to do it in the name of the nonprofit, that particular project. And it is of greater benefit from a legal standpoint, as well as underwriting, when you set up a legal structure where the borrower is a single purpose entity. So if you're looking to develop a parcel of land that is going to be your, whether it's an income producing property or even owner occupied, that you're seeing how that legal structure supports the endeavor. For income producing properties, typically it is a single asset entity. So you're looking at providing a mixed use project, and it's 123 Main Street LLC. And even in some cases where I've dealt with affordable housing developers, if it's a 1 to 4 family property, they've even wanted to designate that 1 to 4 family property located on that parcel as 123 Main Street, New Jersey LLC. It just makes it a lot cleaner from a legal standpoint and to underwrite it as well. And the cost of setting it up from a legal standpoint is really de minimis compared to the benefits. As indicated previously, we're looking at a loan to value on these structures of 80%, a debt service coverage ratio of 1-2 times. And when it is even when it's a nonprofit and you're setting up this LLC as a single purpose entity, we're still sometimes going to look for a guarantee from the parent entity, because the contracts that support the overall endeavor of this venture may be coming from that source. So guarantees may still also be part of that structure. And for for-profits, that's usually a standard scenario. When there's 20% or more ownership of a LLC, we're going to want to see the guarantees from those individuals. You want to look at a vacancy loss collection of 5%. That's a minimum standard. Sometimes if it's a very difficult tenant that you're, like retail tenant that you're trying to attract because you really want a credit quality retail tenant, you might even go a little higher. But the minimum is 5%, and we're going to factor in a management fee. Even if you as the nonprofit or the owner-operator sponsor manage that building, we're still going to put that 5% in our analysis, because that's what the market would require if we had to go out and get a management concern to manage that real estate property. An allowance for replacement reserves. You want to make sure that we don't have deferred maintenance on a property. So we're going to build that, should be built in on an annual basis at 5% of your setup. We also look at the liquidity. We want to see that if for some reason you're not able to have a tenant pay 1 month, that you do have a little bit of liquidity on your on your balance sheet to be able to sort of go through that drought period, which could be only a 30 or 60-day cycle, but we want to see that there's at least some degree of liquidity on the balance sheet. Next slide. Here, the area of housing and neighborhood stabilization, where the project could be for sale or rental. We haven't really seen much for sale activity given the economy of late, but we're hopeful and optimistic. We're seeing a little indications that maybe the for sale market is coming back in some critical areas. But I'm going to talk about, for the purpose of what's on the slide right now, I'm going to talk about more of the larger scale projects where they might be rental, what we're looking for. We want to know whether or not the project has a phased-in approach, or is it all one single building? If it's multiple buildings that create the development site, are we looking to refinance an existing project? We will, for nonprofits, allow some cash out of developer equity, but if it's a for-profit entity, typically that is something that we don't typically like to support. But for our nonprofit partners, sometimes the cash out of developer equity is critical to help you go on to that next major project that you're contemplating. And what we're seeing now that we think we've turned somewhat of the tide with the economic cycle and creating job growth, and in the areas that are experiencing gentrification, which is in our bigger cities, we're starting to see that the need to acquire sites quickly before they're not able to be garnered by community economic development partners. We've developed this new product, a small acquisition line of credit. It's $500,000 or less, and these funds must be specifically used for affordable housing projects. They can be for sale or rental, but for the most part, it will be for sale, where you could acquire that property, rehab it, and do some reconstruction. You have the ability to buy some foreclosed properties. We understand that the primary source of repayment would be the sale of that home to an affordable homeowner. And we know that a lot of our nonprofit partners, you're working on getting folks through the pipeline of home buyer counseling, and there's folks waiting in the wings that are ready to be a home buyer. They've addressed their credit. They're anxious to now take on the American dream of home ownership and build wealth through equity in their home. The benefits of this small acquisition line of credit is that it's unsecured. There is no appraisal or title work required. That it gives you the ability to compete with those cash buyers out there that are grabbing up these properties for acquisition. No construction monitoring, and there's no cleanup period for this small acquisition line. But we want to see this line revolve, where you're going in and out. So that's what we're going to look at when we consider renewing it after 12 months. Primarily, we see this as a critical product solution for developers like network members that have a track record where they've experienced buying and selling properties to affordable home buyers. This gives them that flexible product that they can go in, acquire a site, rehab it, and within 3 to 4 months, they can flip it to an affordable homeowner. And this just allows a little bit of scattered site where you have a neighborhood that is fairly stable. They might have 2 or 3 properties in that block that need to be addressed. That's what the flexibility of this small acquisition line of credit provides. So on the last slide, it's primarily just a recap of what I discussed regarding the various community development loan products, the line of credit for operations, for nonprofit owner-operators, mixed-use development, where we're looking at investment real estate properties, maximum loan size of $10 million, and just recently the acquisition renovation line of credit, where we're looking at a $500,000, very flexible, 1-year line of credit, no security, really based on your financial strength and your track record of doing development. So I'm pretty much covered the base on the loan products that are covered in my space. If there are new market tax credit or LIHTC, I have partners that work directly with community development banking. They're an extension of the bank's commitment to support CRA. So I pretty much run as, if you can say, quarterback in assisting nonprofit partners in finding the right solution. And I'll open it up for questions at this point, Sharon.
Perfect. We have a few here, and I'm going to start with one that is right here at this page, because the question is, this is a very brief bullet point of everything you just covered. Is there anywhere that has greater detail that backs up all of the things you just talked about on your website or somewhere that people can refer to?
No, but what I can do, Sharon, is I can send you a follow-up document that will give you the details of this small acquisition line of credit that I gave all the benefits to this. I can do that for you.
That'd be great, and we can get that out to everyone who's on the call. The other question that came up here is, you referred earlier to, what do you consider a positive community impact? You were talking about, for approved programs for projects. So what do you consider that? Do you have an example of what might be a positive community impact type project?
Well, the ones that are no-brainers are when it's part of the neighborhood plan. That's the NRTC program, which we are a participant in. Outside of the NRTC, there still are areas where nonprofits have pretty much claimed a stake. That's like their neighborhood. Whatever work they've done in working with partners and stakeholders in that neighborhood, I think starting work there is showing that positive impact. Sometimes it's not always going to be tied directly to a plan, but if there's been some activity working with community partners and stakeholders that identified this corner is an issue and that we want to address, bringing some targeted efforts to turn that around. So I don't know if I really answered your question exactly, but I would say most of the nonprofits. Okay, most of the nonprofits know, even though it may not have a formal plan, this corner has been a problem of late, and even we've been working with the public safety folks, and we're working with the neighborhood block association captains. To me, that's enough to say doing something here is a positive impact.
Terrific. Folks, as I'm asking the questions that have already been written up, if you have any other questions, type them either into the question section or the chat box on your screen, and we will ask them for you. I do have a few more that are here. The project, hold on. I'm sorry, I had to sneeze. If a project does not have all the tenant slots under contract, can that project still be considered? Or does it have to be a certain percentage?
No, I mean, everything is a work in progress. We do understand that. And I would say you want to have a good majority of letters of interest, because clearly it's a chicken egg. You can't have a signed lease for something that you still need to put in place. So if you have letters of interest that show some promise that you've got a majority of that real estate project in tow, that's worthy of a discussion, and we can start talking about what you need to look at addressing to shore up the base. So a lot of times I am talking to folks earlier in the process, and not when it's like ready to be, finalized.
Actually, Darlene, that was a question that's here. So when do you like to be brought into the discussion? At what phase of the project would you think was a good first step with reaching out to you?
Sharon, I would say I'm open to discussion with not your members, because that to me is the great partnership that PNC wants to offer. We have a different business model. I don't take a project that's ready to go and put the cake in the oven and give it to another lending group. We are the lending group. So we understand that it takes some technical assistance. It takes some conversations. It takes, a lot of different scenarios to say, what if this happens, or what, maybe you might want to look at this approach. I'm fairly early in the game when I start talking to nonprofit borrowers about their intentions to develop a site. So it's never too early. I hope I answered the question.
Yes, I think you did. We have a group of questions yet. You mentioned before a large project, and the question comes up here: what do you consider a large project?
Oh, when I was talking about the housing and neighborhood stabilization, when I said how larger scale projects, that's something that to me is more than just a 1 to 4 family. Okay, that's what I was really speaking to. Community development banking, because our maximum loan size is $10 million. That can kind of, you can craft what that means by that number alone, that you can't get too big. You probably don't have more than maybe 10 housing units, or, the project itself is, maybe 10 to 20 units if your loan size is 10 million. When it gets larger than that, I'm typically talking to my partners in low-income housing tax credit. At that point, you're probably looking at a LIHTC type project. And so I'm kind of referring you on to my partners at that point.
And on the flip side of that, the question was, is there a minimum to a project that you would be handling?
Well, the minimum I would say is probably $250,000. That's the minimum. I have done lines of credit less than $250,000, but I would say that's, given where we are and what we're seeing in terms of the capacity and the history and the track record. New Jersey has some nonprofits that have been around for 30 and 40 years, and there really aren't too many startups. And if they are startups, I don't think they've been around to a point where they're needing financing or can even obtain financing, really. So I think the minimum is probably a fair number, 200. Maybe you can squeeze it down 200, but for the most part, 250.
Okay. There's a couple questions popping up here. So what types of guarantees do you look for from governments besides pilots to ensure that a community development project will be supported by the government?
Well, when I was talking about guarantees, I was talking about, let's say, when the nonprofit ABC nonprofit company develops 123 Main Street LLC. So 123 Main Street LLC might be the legal entity that owns and operates that real estate project. Excuse me. But the parent nonprofit is ABC Nonprofit Company. That's a guarantee, because they're primarily they're the financial institution or the borrower institution, I should say, that has credibility, meaning they've been around, they have capacity. This project is happening because of that nonprofit track record. In terms of the municipality guarantee, they're really not on the hook for the loan. That's really the nonprofit and that real estate concern that they spun off as an LLC. We want to see a pilot. We want to see that they're endorsing it. Usually they provide some subsidy. That to me speaks volumes of their commitment in terms of their public subsidy, and that their dollars go in first. So they're at risk. They're saying, again, back to public-private partnership. The first word in public-private partnership is public. So that means a lot. That, to me, is their guarantee, if not in a legal sense of the documentation is concerned.
Terrific. Another question on here is does the small line acquisition line of credit follow a developer or the combined developer/nonprofit partnership? Is it limited to a specific type of project like childcare versus affordable homes?
No, and I would say, let me just make this clear. I'm glad that question came up. The small acquisition line of credit is specifically used for affordable housing projects.
Okay.
And I'll put that in my follow-up to you, Sharon.
Terrific. The other one here, and I think that's our last question. Oh, another one popped up too. Oh no, that was okay. So how do you address deed restricted projects?
We see them all the time, and that's part of the work that we do, and so our underwriters are familiar with deed restricted projects. That is what makes this community development. So, for instance, I have an affordable housing developer that I've done about 3 or 4 different projects where 2 of those 4 projects were deed restricted. The municipality required a deed restricted, and how they recorded a mortgage, that wanted to make sure that this property for the next 15 or 20 years remained deed restricted. We moved forward. We had that deed restriction subordinated to our mortgage note. So we understand that mortgage that they recorded as part of their subsidy dollar was really to perfect their deed restriction requirements. So we incorporated into the transaction that actually gives us great comfort to know that they are going to remain affordable housing.
Okay, terrific. It looks like that was the last of our questions. So I know you said you'd send a little additional information to us, and we will add that to what we are sending out to everyone, the slides and your backup information you're sending now. Just a reminder for everyone that this recording goes on our website, and if you are a member, you have access to it at any time by logging in and putting in your passcode. Darlene, this was wonderful. It was full of a lot of information, and as always, I learned something every time I listen to you speak. So we appreciate you being on the call today, everyone. We definitely appreciate, Darlene, you giving us the time and going through all of this with us, and I know that you're available for people to call you and speak to you directly, and I know that that is something that really makes a difference for many people to be able to talk about something specific. So thank you so much, Darlene. Thank you for everyone being on here. Happy first day of summer, everyone, and we will let you know of the next webinar coming up, but again, we appreciate all of you being with us today. Thank you, Darlene.
Thank you, Sharon. Have a great day.
Bye-bye.
Bye-bye.